Welcome back, everyone. Thank you so much for joining me. Another big week at the Federal Reserve, and just as I predicted, interest rates are not going anywhere. But behind the Fed's decision to hold steady lies a far more complicated story. We're talking about weaker growth, higher inflation, growing divides among our policymakers, and a fresh wave of economic uncertainty sparked by new tariffs and geopolitical tensions. So on Wednesday, the Federal Reserve voted unanimously to keep the benchmark federal funds rate steady, holding it in a range of 4.25 to 4.5%, right where it's been all year long. And that is despite new projections showing slower growth, higher inflation, and rising unemployment. This is a perfect storm
at this meeting. So, and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
Donald Trump reacted to the Fed's decision right away. He said the rate should be a whole 2 points lower, said Trump. Take a look.
We should be 2 points lower. It'd be nice to be 2.5 points lower. We'd be saving $800 billion, $700 billion. That's a lot of money, right? Take it for nothing, for absolutely nothing. We'd save $600, $700, $800 billion. We have, I think we're 38th now in interest, and we should be number one. We should be the lowest. Now we have a man that just refuses to lower the Fed rate, just refuses to do it. Maybe I should go to the Fed. Am I allowed to appoint myself, Doug? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people.
So why no cut yet? Well, Fed Chair Jerome Powell says the central bank wants to wait and to learn more about the economy's direction before making any moves. In other words, the Fed's in a watch and wait mode right now. One of the reasons is that the Trump administration might decide to join Israel's war on Iran any day, in which case all hell will break loose for the United States economy that has been on a downward spiral already. But behind the scenes, there is a growing divide. According to the Fed's latest projections, 10 Fed officials now expect at least 2 rate cuts by the end of this year, while 7 see no rate cuts at all. So just a few months ago, you might recall this, fewer were expecting 0 cuts. Now the majority of them are saying, yeah, it's probably not going to happen with how things are going. So this mixed messaging reflects just how uncertain things are right now, and Powell certainly admits it openly. He says no one holds these rate paths with a lot of conviction. Now, there's a major wild card that we need to be aware of. The 90-day pause on the US-China tariff war is going to expire this summer, and of course, I'm referring to tariffs. The Fed's latest forecast is the first forecast since President Trump announced sweeping new tariffs back in April. And the impact is yet unclear, but it is expected to weigh on growth in the United States and to push prices up. Powell did say that the Fed expects tariffs to eventually hit consumer prices. It's going to happen. There's no way around it. We know it's coming, he said. We just want to see it before making policy moves. That caution is shaping the Fed's strategy, and right now escalations in the Middle East add more complexities and more fears to the mix. The Fed's updated forecasts show just how thorny the situation is, and it is actually getting worse. Inflation is now expected to end 2025 higher at 3% officially, up from 2.7%, and that's official inflation. Growth is also downgraded to 1.4%, and guess what? Unemployment is projected to rise to 4.5%. So this is shaping up to be a perfect, an absolutely perfect storm. So it would be wise to start getting finances in order as much as possible. It is indeed a classic policy bind. Inflation is too high to justify cuts, but growth is too weak to raise rates. And all of this is happening as Trump renews his push for the Fed to cut rates, saying that, again, Powell is just too late. He's Mr. Too Late, as Trump referred to him. So what are the markets thinking? How did the market react to this? Treasury yields barely budged after the announcement, and traders still expect 2 rate cuts this year, possibly starting in September. That aligns for now with the majority of Fed officials, but that consensus is, of course, very, very fragile, and it depends on so many moving factors. And it could easily shift depending on how tariffs, how inflation, and global trade evolve in the coming months and days. Meanwhile, America's top CEOs are getting more and more pessimistic. A new Business Roundtable survey shows that their economic outlook has plunged to its lowest point since 2020. The CEO index fell by 15 points, which is a clear signal of growing pessimism. More than 40% of CEOs now expect to cut jobs, so we should expect layoffs, and this is why unemployment will rise in the next 6 months. And that is up sharply from last quarter and double what we saw a year ago. So this is clearly deteriorating quickly. Capital investment and sales expectations are also down. So again, we're talking about a massive economic slowdown in the near future. What's driving this CEO anxiety? Well, uncertainty is the big factor. Uncertainty, especially around trade right now. Of course, we have a possibility of the United States going to war for Israel. That's also a possibility, but at this point in time, the survey results were primarily focused on uncertainty in trade. The administration's tariff push has clouded the outlook for hiring, for investing, and for expansion. As Cisco CEO Chuck Robbins put it, the survey results signal caution, and they certainly do. CEOs want more than just tax reform. They want stable trade policy. They want to be able to make forecasts that are meaningful to their business, and they can't do that now with so much being up in the air every single day. They want open markets, and they want predictability. All of these things are certainly in short supply right now. So to sum it up, the Fed is staying patient. Markets are still betting on cuts, but the economy is flashing warning signs like never before. With tariffs in play and CEOs turning cautious, the road ahead could get really bumpy. So what do you think? Should the Fed cut rates now or hold steady? Drop your thoughts in the comments below. As always, I would love to hear from you. And remember to show your support, like, subscribe, and share. Support my work on Substack and Patreon. You will find those linked in the description below. Enjoy the rest of your day, and I will see you back here soon. Bye for now.